Welcome to this explainer. Most people look at Ferrari and they just see a really fast, really red sports car. And sure, on the surface, that's absolutely true. But if you stop there, you're missing the absolute genius of their business model. Today, we're going to look at Ferrari not as a traditional automaker, but as a luxury scarcity machine with a wildly unique valuation premium. We are going to break down exactly how they manage to monetize the simple act of making you wait. The core thesis of our explainer today is captured by this one idea. Ferrari does not simply sell cars. It sells allocation. Think about that for a second. For Ferrari, their true economic moat isn't actually horsepower. It's not aerodynamics, or even that iconic Italian design. It's controlled scarcity. The absolute most valuable product they have isn't the physical car itself, but the privilege of being invited to buy the next one. They're literally selling entry into a highly exclusive hierarchy. Okay, let's dive into this fascinating concept called queue rights. Essentially, this is the psychological and economic value of the waiting list. Now, in normal retail, right, a seller wants to remove friction. If you got the money, you get the product. Simple. But in Ferrari's world, payment is nowhere near enough. Buying a car builds your position in a hierarchy so you can access future, more exclusive models. The waiting list itself acts as this incredible profit machine that supports their pricing power, protects the resale value of the cars, and builds just intense customer loyalty. So, to really understand how this magic works, we've structured today's deep dive into 3 distinct layers. First up, layer 1, the automaker illusion. Then, layer 2, the scarcity flywheel. And finally, we'll look ahead with layer 3, the electrification test. Let's jump right into layer 1, the automaker illusion, and how they completely defy traditional automotive manufacturing. If you try to value Ferrari like you would Ford or GM, their premium makes absolutely 0 sense. But if you view them as a luxury maison that just happens to build engines, suddenly it all clicks. To prove this, just look at their 2025 shipments. They shipped exactly 13,640 cars. That's actually down 0.8% from 2024. Now, during a model transition year, almost any other automaker on Earth would have slapped on incentives, slashed prices, or pushed volume just to keep delivery numbers up. Ferrari? They did the exact opposite. They deliberately kept deliveries flat, strictly refusing to chase volume. They're literally just sticking to founder Enzo Ferrari's famous golden rule: always produce one fewer car than the market demands. Now, what's really interesting about this is the crazy financial paradox it creates. Despite shipping slightly fewer cars, their 2025 net revenues jumped to 7.146 billion euros. That's a 7% increase. This right here beautifully illustrates the brilliance of their business model. They grow their value so much faster than their volume. By artificially constraining supply, they basically force growth through pricing and product mix, instead of just pumping out more units onto the streets. The absolute crucial point is in these key growth metrics. So we see that 7% revenue growth, right? But look at operating profit, or EBIT, that's up 12%. And even more mind-blowing, industrial free cash flow exploded by 50%. 50%. This all happens because of a richer product mix. When customers know these cars are incredibly scarce, they opt for the higher value models, and they just pour money into personalizing them. And that drives this exceptional margin expansion without the company needing the massive overhead of scaling up new assembly lines. Let's just pause real quick to recap this. An EBIT margin of 29.5% and an EBITDA margin approaching 39% are practically unheard of in traditional auto manufacturing. I mean, these are pure luxury territory numbers. And with an order book stretching all the way to the end of 2027, they have extreme visibility. They aren't stressing about selling cars as they build them. They are managing a multi-year forward pipeline of pure desire. All right, that brings us to layer 2, the scarcity flywheel, and how exactly they monetize the right to wait. So this flywheel is the operational engine humming behind all those massive metrics we just looked at. It's their calculated strategy of converting consumer desire and extreme scarcity into cold, hard cash flow. To get it, you have to understand the psychological journey of a Ferrari buyer, which we call the client ladder. You see, you don't just walk in off the street with a bag of cash and buy their rarest hypercar. No way. First, you have to buy a regular production model. Then you build a relationship with your local dealer. You show up to events and you prove that you aren't just going to flip the car for a quick profit. Next, you deepen your personalization on subsequent orders. And only then, at the absolute top of the ladder, do you unlock access to those highly coveted limited editions or Icona supercars. Buying the base model? That's literally just your entry ticket. Let's see how this builds into such an incredible revenue stream. Personalization is really what turns that emotional desire into pure margin. When a client finally gets their allocation after waiting for months or even years, they want to make that car uniquely theirs. They're adding custom paint, carbon fiber details, totally bespoke leather stitching. And economically, this is brilliant for Ferrari, because adding those touches requires zero proportional increase in car volume. Plus, a highly customized one-of-one car is much harder to commoditize or price compare against something else. It deepens the owner's emotional attachment to the brand, and the extra markup charged for those options far, far exceeds what it actually costs to produce them. And what's the result of all this demand generation? Ferrari's order book extends toward the end of 2027. Just think about how wild that actually is. Imagine paying hundreds of thousands of dollars today for something you won't even get to see or drive until late 2027. Because they are sold out for years, they effectively eliminate the need for discounting entirely. This one fact represents Ferrari's most important invisible asset. They have ultimate pricing confidence and rock-solid stability in their production planning. They aren't sitting around worrying about next quarter's sales. They are curating a multi-year waiting list. To summarize layer 2 here, the mechanics of this scarcity flywheel are deeply, deeply intertwined. Supply discipline protects residual values, which makes buyers way more comfortable paying premium prices because they know the car is going to hold its value. Personalization raises the revenue per unit without adding to the overall supply on the road. And those ultra-rare limited editions, they strengthen collector demand right at the top of the pyramid. Disciplined scarcity is the absolute bedrock of their pricing power. But hey, no business is totally invincible. Let's shift our focus to the future with Layer 3, the electrification test, and the identity risks on the horizon. So, Ferrari faces a massive strategic hurdle right now, translating a very loud, combustion-based heritage into the silent EV era by 2030. And this brilliantly illustrates why this is culturally quite dangerous for them. While 6 billion euros comes from cars and parts, a massive 820 million euros comes from sponsorship, commercial, and brand. That slice right there, that is the Formula One racing myth. That's the sound, the emotion, the visceral thrill of an engine that people are actually buying into. They're monetizing the prancing horse identity globally, and that identity has historically been tied to roaring engines. So the identity risk is pretty stark. Legacy internal combustion engine models offer emotional theater, mechanical vibration, and a legendary sound born from decades of proven racing heritage. The upcoming EV era, though, it offers silent electric performance in completely uncharted technological territory. So the defining question for investors is this: can an electric Ferrari maintain that exact same emotional resonance? If an EV Ferrari is incredibly fast, but completely silent, does it still justify the years-long waitlist, the insane premium, and the passion? Well, Ferrari's management certainly thinks they can navigate this. Their 2030 Capital Markets Day targets project net revenues of around 9 billion euros. They expect adjusted EBITDA to hit at least 3.6 billion euros, with an EBITDA margin of at least 40%. And they're targeting a cumulative free cash flow of about 8 billion euros between 2026 and 2030. It's fascinating because these numbers show that management firmly believes their scarcity engine is powerful enough to easily overcome the massive capital requirements and the tricky identity shifts of the EV transition. Wrapping up our deep dive, we do have to take a sober look at the macro risks here. Overproduction is by far the biggest threat. If they chase volume and build too many cars, they weaken the waitlists and the residual values that make this whole model work in the first place. Then there's the EV identity shift, which could dilute brand emotion if the new cars just don't feel Ferrari enough. And finally, regulatory costs regarding emissions and trade tariffs could continually put pressure on their margins via compliance. Which brings us to our final thought for today. Ferrari is absolutely one of the clearest examples in the world of how scarcity can be monetized at an industrial scale. I mean, they have trained the wealthiest consumers on the planet to be genuinely grateful for the opportunity to spend hundreds of thousands of dollars years down the line. But looking ahead at shifting technologies and changing consumer expectations, you have to ask yourself, can Ferrari keep selling the right to wait without making customers tired of waiting? Think about that as you watch how this iconic brand navigates the next decade. Thank you for joining me on this explainer, and keep questioning the models behind the magic.